was important to be so clear with Canadians that rates will stay low and that you will stand ready to be quantitative easing for as long as necessary?
Amanda, the recovery started, and we're seeing some good numbers, but it's going to be a long climb back, and considerable policy support is going to be required. Fiscal policy is taking a lead, but monetary policy has an important complementary role to play. And we want it to be very clear to Canadians that the Bank of Canada is going to be there through the full length of this long climb back.
And give us a sense, I know we've seen your projections out to 2022. You're projecting growth for the economy if all goes well. How long do you see you remaining accommodative?
There's a lot of uncertainty out there, and so we didn't provide a regular projection. We provided something we call a central scenario, and we did that really to highlight that it's highly conditional on the course of the virus itself. We expect a recovery in two phases. We expect to see a pretty good bounce back through the third quarter, but then we see a longer, slower, bumpier recuperation phase. And our message to Canadians is that the Bank of Canada is going to be there to support recovery through both phases. And to make that message clear, we provided an unusual amount of forward guidance indicating that the policy rate would stay at the effective lower bound until economic slack is absorbed, so that our inflation comes to our inflation target of 2%. We reinforce that with a continuing commitment to our quantitative easing program to buy at least $5 billion of Government of Canada bonds per week. We didn't put that forward guidance on a calendar. I expect other forecasters will. But if you look in the monetary policy report, it's pretty clear from the charts that are provided that in our central scenario and in scenarios close to it, that would imply that the policy interest rate would be at the effective lower bound for at least 2 years. There's a lot of uncertainty around that scenario, but I think the message is pretty clear. Interest rates are going to be very low for a long time.
Some of the uncertainty, of course, is around what the recovery looks like. We've seen this gradual reopening in Canada. We don't know yet whether we'll see any rebound or spikes in COVID. As you say, it's a scenario because there are so many unknowns. Are you pretty confident about the path we're taking?
I think it's hard to say we're pretty confident. I think we are very confident that a considerable amount of monetary stimulus is required, and that we're going to have to keep that stimulus in place for a considerable amount of time. The purpose of putting out a central scenario is that even though there's considerable uncertainty around it, it is the scenario that guided us in our policy deliberations. And as data comes in, we'll be evaluating that relative to that central scenario. If we need more monetary stimulus, we'll do that.
What might that look like? You've said, and obviously you were there in 08, 09. We didn't get into quantitative easing then. We're there now. The bank's balance sheet is expanding. It'll continue to do so. What would the next step look like, or a different step of accommodation look like?
Well, we discussed, and we have a variety of exceptional monetary policy tools. We're using LSAPs, or quantitative easing. Those programs can be scaled. Our balance sheet has expanded rapidly, but it's still relatively modest when you compare it to some other major central banks. There is certainly scope. We've used forward guidance today. There are other types of tools like yield curve control that some central banks are using, like Australia and Japan, and we're certainly looking at their experience. So, as I said, if we have to do more, we have the capacity, and we will do more.
And when you talk about more things like yield curve control, et cetera, would that be a second wave that forces an economic shutdown again? Are we talking dire scenarios there?
Amanda, there are a lot of scenarios around the central scenario. As I said, we'll be evaluating incoming data relative to that scenario. I think we're expecting to see some very good numbers in the near term. Once we get through that near term, it's going to be very important to assess how many jobs are not coming back, how much damage is to the economy, how many businesses are not reopening. And at that point, we'll get a better sense of what this second bumpier recuperation phase of the recovery is going to look like.
And I guess that's, I mean, one of the unknowns is how much of the lost growth is permanent. Are you beginning to start to try to forecast that or understand what that looks like, or do you have to wait the months and months before we actually begin to see what the carnage looks like?
Well, we're beginning, but we are at the very beginning of what is going to be a long recovery, we in the monetary policy report we do lay out our assumptions for the supply side, but there's no question we will be updating those as new information becomes available. There's a lot we don't know.
You know, when we went into this pandemic with concerns about the level of household debt in Canada, and there were even growing concerns about where we were in the debt cycle on the corporate side, getting a little late in the game. We're now, of course, being told we're low for long. Presumably, the assumption is we should go out and borrow. What's your thinking around the concern about household indebtedness?
We've highlighted, as you suggested, a number of times that the high level of household indebtedness is a vulnerability for the Canadian economy. Right now, the most important thing is to support recovery and get people back to work. The best predictor of whether somebody is going to pay their mortgage is whether they have a job. And so, yes, there are high household indebtedness is a vulnerability, but supporting the recovery and reducing that vulnerability are entirely aligned. And by holding interest rates low across the yield curve, that will reduce debt burdens for Canadians. The other thing I would underline is that fiscal policy is playing an important role. Fiscal policy has replaced the incomes that Canadians have lost on average as a result of COVID. We've actually seen the savings rate go up. And certainly some households are paying down debt. Yes, it's a vulnerability, but the best thing we can do to minimize that vulnerability is support recovery and keep rates low.
On the fiscal side, I mean, we've obviously, we avoided worst case scenarios, as you note yourself in the NPR. Things weren't as bad as we feared they would be. Some of that will be because of fiscal supports. When you measure the risk of removing fiscal support too early because of concerns about deficits versus the mounting deficits and the long-term consequences, where do you come down?
Well, as you suggested, what we've learned from past recoveries is that if you withdraw the policy support too early, there's a real risk of stunting the recovery, stalling the recovery. That harms Canadians. It also ends up costing more in the end. So the fiscal stimulus that's in place is extremely important. The wage subsidy has just been extended. That will certainly be helpful. Yes, we've also learned from our experience in the 1990s when we had our own debt sustainability problems. When you have a large structural deficit, that is harmful and ultimately it's unsustainable. So certainly that is something to avoid. The good news is Canada started from a strong fiscal position. We had no structural deficit, and we had the lowest debt to GDP ratio in the G7, which we still have today.
We have this interesting debate now between whether we have more to fear from deflation or inflation. And I know one clever answer is we'll see both. What's your view of what might be headed our way in terms of, I don't mean healthy inflation, but inflation that we need to fear?
Well, right now, inflation's about zero. we have a large, certainly our best estimate is we have a large output gap. Yes, supply has contracted, but demand has shrunk considerably more. That's putting further downward pressure on inflation. So we expect that inflation is going to remain weak for some time. And given that it's already around zero, we're more worried about disinflation than inflation. And that's really reflected in why we've provided clear forward guidance that interest rates are going to be low, very low, for a long time.
There is so much uncertainty, but just one last quick question I'd ask. What's the thing you think is the biggest risk to your own scenario?
Well, clearly a huge risk and a really unknowable risk is the course of the coronavirus itself. In our central scenario, we have allowed for some local flare-ups and some local restrictions. And I think it's going to be very important for Canadians, for businesses, to make sure that they're ready for those local flare-ups and we can manage them and use fairly local responses. Clearly, the biggest risk is that as we reopen the economy, we do get a widespread second wave and we need another second lockdown. That would certainly be a big setback for the recovery. It would put us well below our central scenario, and clearly there would be a need. That would be a case where we would definitely need more monetary stimulus.